Thank you very much, Mr. Carney and Mr. Macklem, for appearing before us today. I want to raise first issue is that of housing prices. The October 23rd edition of The Economist magazine has cited Canada as having a housing bubble. In fact, comparatively, The Economist believes that Canadian housing market is overvalued compared to countries like China and the U.S. How concerned should Canadians be about this risk, and what does this housing bubble mean to Canadian families?
Thank you. Welcome to the committee. Thank you for the chair for the question, Mr. Brison. Make two distinctions. First is the bank's expectation with respect to economic growth has been that activity in the housing sector, the broad housing sector, meaning housing starts, renovations, and housing sales, and the commissions that come from those, would decline markedly starting in the second quarter of this year and continuing over the course of this year. That is what we've seen. So the activity, the level of activity that we've seen in the housing market has been consistent with our expectations, and that has been a function of basically a concentration of housing activity at the end of last year, through last year, and the start of this year because of pent-up demand, pulled forward demand because of the HST coming into place, pent-up demand because of the recession, obviously, and also the home renovation tax credit, the positive impact of the home renovation tax credit. So there's been that concentration. Now we see the decline markedly. The separate issue of the levels of valuations of housing, I would say that our expectations is that housing price appreciation and the net worth accumulation associated with the house price appreciation over much of this past decade has provided stimulus to consumption, and we do not expect that that stimulus will be there over our projection horizon.
That there could be a correction, in fact, in the housing prices in Canada?
We believe that one of the important downside risks to our projection is the possibility that there is a more abrupt correction in the housing market than we're anticipating. We're not forecasting an abrupt correction, but it is a possibility given two factors. First, the speed with which house prices rose, and secondly, the absolute weight of debt in the economy that is tied to housing.
Yeah, you raised recently the issue of household debt in Canada, and the TD Economics report further validated that risk. And I'd appreciate some of your insight as to what government policy levers we should be looking at in order to reduce the risk of excessive household debt, what kind of regulatory reform we can be looking at, and in terms of macroprudential measures, what are some other countries doing that we ought to be doing in Canada?
Okay. Let me begin by saying that there are, make absolutely clear that there are limits to the role of interest rates in addressing this issue, or more specifically the role of the Bank of Canada's interest rate. We conduct monetary policy with the sole objective of achieving our inflation target, and that's the agreement with the Government of Canada, and as you know, it's a 2% inflation target. So issues around financial stability and potentially issues around potential emerging vulnerabilities in the household sector are best addressed by other tools. And sometimes those tools are termed, as you just did, macroprudential tools. The options include changing elements of the terms of mortgage insurance as the government, CMHC, mortgage insurance, as the government did earlier this year when it introduced some restrictions on the use of high loan-to-value mortgages for investment properties. It changed the qualifying interest rate. It made some other adjustments. We are starting to see the effects of those adjustments on cooling activity in the housing market. So that's one type of tools. I will say that changes of this type, everybody has a different housing system around the world, but changes of this type, including direct regulation on loan-to-value ratios for mortgages, is an instrument that has been used in a variety of other locales. And the issues that I would further point out that the issues that we are facing in a period of low interest rates and relatively stable prices with accumulation of debt and some asset price pressures are common to other economies around the world today who did not have the financial crisis. We felt the effects of the financial crisis, but we continue to have financial systems that work and policies relatively low. So measures the options in Canada includes those type of measures. The other option, which is not something that has been done, nor are we in an immediate position to do, would be adjustments to the level of capital through the cycle that banks carry against certain types of lending, including to housing.
Thank you. Between 2006 and 2009, in the 3 years leading up to the economic downturn, government spending, program spending in Canada increased by 18%, just the program spending component. As we enter a period of recovery, even halting recovery, is that kind of spending increase, program spending increase, 18% over 3 years, 3 times the rate of inflation, economically sustainable?
Well, well, we don't give precise projections for the growth of nominal GDP, as certainly this committee would understand. The revenue side of government finances, whether they're federal or provincial, are closely tied to the growth of nominal GDP. It would be inconsistent to sustain that level of spending increase and be consistent with a gradual reduction in the level of deficits as have been planned on both the federal and provincial side. That's not going as far as your point on economic sustainability, but in terms of consistency.
Thank you, Mr. Brison. Monsieur Paez,